This video continues our discussion of the closing process. Up until now, we want to remind you the closing process is the resetting of all the temporary accounts. You're already familiar with what those are. And in the previous video, we actually looked at the closing of the revenue accounts. Just to remind you, this is an example found on page 198 to 201 of your text. So like I said, in the previous video, we saw the closing of the revenue accounts for this business. It's the teaching revenue and equipment rental, and we ended up with a balance of $61.50 in the income summary account. We're going to now look at closing the expenses, and the last temporary account being the owner's withdrawals. So here are the expense accounts. We know that expense accounts have a normal balance on the debit side, and so in the big reset, they've been accumulating expenses all year long, and now we want to zero them out so that they have a zero balance we can start accumulating for the next year. And so this is the transaction that results from that, or the journal entry, where we're going to credit each one of the expense accounts in order to zero them out. So for instance, salaries expense originally had a debit balance of $1,470, and as part of this entry, we credit it for $1,470, resulting in a zero balance. So that account is all set, ready to go to start accumulating how much we pay our employees for the next accounting period. So the total of all those credits to all those expense accounts to zero them out was $4,085. And that $4,085 goes through as a debit to income summary. The result being our $61.50 credit from when we close the revenue accounts, a debit of $4,085 when we close all the expenses, and the resulting balance being a credit balance of $2,065. Now that $2,065, if you look at the worksheet for this problem, looks pretty familiar. That's actually the net income for the business. So what do we do with that now? Well, it's sitting in this income summary account, and I've mentioned before, the income summary account is the uber temporary account. It exists only for this purpose, for the closing of accounts. And so now we need to zero it out. We don't want it hanging around. And the only reason we actually used it was to find out, to make sure that we know what the net income was, because whose net income is that? Well, it belongs to the owner. So it's going to be transferred to the owner's investment account, it being, in this case, Virgil Klein Capital. And so the entry to do that is to debit income summary for $2,065. That effectively zeroes that out, and credit Virgil Klein's capital account for $2,065. So that's the net income being transferred to the credit of the owner. Because remember, any money that the business makes really belongs to the owners to do with what they will. Now Virgil has some options around that $2,065. He can leave it in the business, so it continues as his investment, or letting his bet ride on the, if we look at a gambling example. So he could leave it there, or he could choose to take some of it out. And during the course of this year, Virgil actually chose to take some of the money out. He did that in the form of withdrawals. And remember, withdrawals now is a reduction of the owner's investment because the owner is taking some of their investment back out. And the withdrawals account carries normally a debit balance of $600. To zero that out, we credit it for $600, and that zeroes it out. And what happens to that $600? Well, we reduce Virgil's capital account by that much. And so the closing balance then in Virgil's account is $11,465. Remember, there isn't a big pile of money, $11,465 sitting around anywhere. Virgil put the money in the business used that money to do things like buy assets and pay bills and do all sorts of things. In fact, there isn't very much cash actually hanging around in this business. The business is actually using it to do things. Now, if you look at Virgil's capital account, that might look kind of familiar to you, especially if you've done the statement of changes in equity, because in fact, those transactions very much reflect the statement of changes in equity for the owner. It reflects the owner's investment during the period, the $2,065 that was the net income, and the $600 that was withdrawn, leaving the owner's ending capital balance of $11,465. So if you were doing the statement of changes in equity, you would hope that you would end up in exactly that same position. Good practice, once again, problem 5-4A and exercise 5-7 really kind of drive this stuff home. If you're not real solid on it, I strongly encourage you to practice those in preparation for the seminar.